Hi, guys. Good afternoon. First and foremost, I'd like to say thank you very much to all the participants and panelists on our call today. In the interest of getting right into the important information, I'm just going to go ahead and make my initial introduction here brief. For those of you who have not had the pleasure of meeting, my name is Bill Kurtzner. I'm one of the managing partners at Util Auditors. Util is a consolidated solution in cost containment space. We audit 9 different areas of spend, as well as providing some ancillary services and solutions, all of which are cost-saving centric. I think it's safe to say that no business nor industry has been spared with respect to the economic challenges that have been posed by COVID-19. As a result, we've received a number of inquiries from our clients, both big and small, on a broad range of topics. So the purpose of today's call is really to provide some insight and some answers to some common questions that we're getting. To offer some structure to the call, each of our experts that's going to be speaking today will be speaking for up to 10 minutes, and then if time allows, we'll do a brief question and answer following. So if there are questions, there should be a chat module where you can type questions in, and if not, then what we'll do is just do a brief Q&A on some common questions at the end. And if anybody has any more specific questions, they can certainly send them to us, and we'll be sure to address them with the appropriate resources following. So what I'd like to do is go ahead and get started and introduce our first guest to the call. The first topic we're going to go over is workers' compensation, and my first guest is Scott Priz. Scott, are you there?
I am, yes.
Very good. Scott Priz is the Vice President of Advanced Insurance Management, a company that's focused on reducing workers' comp premium costs for small and medium-sized companies. He's been consulting on workers' comp audits for over 15 years. He's also a licensed attorney in Illinois, and he's helped deliver results for and refunds for clients of ours, including Entertainment Benefits Group, Altered States, and a number of others. So on that note, Scott, I'll turn it over to you.
Okay. So there's, in regards to the current, crisis with the virus, there's been two main changes within the workers' comp industry. And I'm speaking from the perspective of employers, policyholders. The two main areas are, as you might imagine, payroll, which affects premium, and then also claims. So obviously the first big thing has to do with payroll of companies. And that is because a lot of companies are having a massive reduction in work. Workers' compensation premiums for most small, medium-sized companies, if they're not loss sensitive, or even if they are loss sensitive, the premium is based off of payroll. And the question is, in the insurance industry, is what happens when you have a sudden drop off in payroll? And also what happens when you have a bunch of pay for idle time, whereby companies are paying their employees not to work. At first, the insurance industry's response under NCCI, the quasi-national rating bureau, was to say that pay for idle time should go into whatever that employee normally did. So let's say you had a roofer, you were paying him, to not work, to try to keep him going. The insurance industry at first said we would treat that as normal roofing time, which was a little outrageous. About a week after they issued those guidelines, they reversed course completely and said that we need to have a new classification code that will create no premium, and that idle time, due to the virus, as long as you keep track of it, will generate no premium. So that's, I guess, my first tip. If you are paying your employees not to work, keep track of it. When the audit comes due, present to the insurance company. They'll put it into a classification code that generates no premium, and it will eventually reduce your bill. The other thing is, now, if you have a workers' comp policy that's on guaranteed cost, get an endorsement now if you've had a sudden reduction in your premium. Insurance carriers should do this, and if you've had if you expect over the course of the year a 10, 25, 30% reduction in your payroll, you should be paying less in your work comp premiums. The way to do that is to get the policy endorsed to have better estimates than there were when the policy started. That'll reduce your current bills at least by whatever you're paying. And again, if you are paying your employees for idle time, let your insurance company know. Keep track of that pay. Let them know at the audit and make sure that gets put into the correct classification code. This is guidance from NCCI. the quasi-rating bureau, and the insurance carriers should follow this. That's on the one side in terms of payroll. The other side is, are there going to be claims that are generated out of employees that have been infected with the virus? And the answer is likely. It's going to depend a little bit on what state you're in. Where I am in Illinois, they recently had an emergency amendment to the rules of evidence for the Work Comp Commission, and there is now a presumption, rebuttable, that if you're a frontline employee, if you're working in a whole slew of industries and you come down with the virus, that there's a presumption that it came out of work. What this means is that companies are going to be facing a whole lot of claims if their employees get infected with this virus. If you're on a loss-sensitive plan, you may very well be paying more in claims for these employees that are covered under workers' comp. The challenge for the employee will be to figure out, this injury, was it caused in the course of their employment? In Illinois, that'll probably be easier than most other states, but if they can prove it, more likely than not, then they will be able to file a claim, and there will be additional costs for employers, either directly if they're under a loss-sensitive plan, or down the road through the experience modification factor. No one's quite sure how it's all going to pan out, but it's very likely there are going to be a significant amount of claims for employees that came down with this, and there's going to be a significant amount of litigation before the various workers' comp commissions around the country. There's going to be fights over, did the virus actually cause this injury at work, or was it something you picked up from a family member? That's something you're going to have to fight with down the road. Right now, in terms of costs, what I'd say is, if your payroll has been shrunk significantly, talk to your insurance carrier, get an endorsement to the policy, and get a reduction on your current year. That's the sort of first thing you can do if you're facing the struggle in your business, to make sure they have good estimates and to make sure that your monthly bills go down commensurate with whatever you think the best estimate is for your payroll. And then down the road, you're likely going to have some claims out of it if you have employees that are continuing to work. And that is, I think, about my 10 minutes. I think that's my sort of what we know right now as to how the industry is going to be affected. There might be some more things down the road with higher rates, or maybe some insurance carriers going under. We don't know yet. But that is what I know right now about this crisis.
Very good, Scott. Thank you so much. I think some really valuable insight, and workers' comp is certainly an area that most businesses are required to carry. So some very broad topics there, and we appreciate you joining. Next, we're going to talk about merchant processing, and my next guest is Joe Hickey. Joe, are you there?
Can you hear me?
Yes, I can hear you now. Okay, great. Joe's the owner of Process Point and Audit Advantage. She has over 20 years of experience in merchant processing and has assisted Util Auditors for clients like Entertainment Benefits Group, Easy Corp, the City of Miami Beach, and more. So with that, Joe, I'll turn it over to you. Thank you.
Hey, Bill, thanks. I actually have Thomas Vavrin, who is our Director of Audit Advantage, that has put together this presentation. So I'm going to turn it over to him real quick, and he's going to go ahead and pick things up where I would have left them off at. Go ahead, Thomas.
That sounds good.
Okay. All right. Well, welcome, everybody, and thanks for taking the time to listen to our call today. My name is Thomas Vavrin, and I work with Bill on the merchant services end. And so, first of all, I wanted to just mention that there are some good things that are happening as a result of the outbreak that we're experiencing. So I don't want this to all be doom and gloom. But so from the credit card processing side of things, first and foremost, I think it's important for everyone to understand that processors are still willing to perform rate reviews. They're still willing to consider cost reductions and any other recommendations that are being made by Util Auditors. So, they haven't completely put the earmuffs on. They're still willing to listen to us, and we can still execute on some cost reductions. So I think that's important for everyone to remember. We do know that processors want to keep your business, and they know that all merchants are experiencing hardships. And some of the items that we're going to discuss below are really just things that those processors have to do in order to mitigate their risk. And so it's not that they're out to hurt merchants. It's really just they're also trying to protect their own business as well. Another really good thing that we're seeing is that the credit card process or the credit card brands, the Visa, MasterCards, Discovers, and American Expresses of the world, they've actually postponed increases to their interchange, brand fees, dues, and assessments. They've postponed those increases till later on in the year. So that is good for all merchants. So your interchange and your cost for processing, you shouldn't see an increase on that end. This is also a really good opportunity for you as a merchant to see how much your processor values your relationship, because how they treat you today in this time of hardship is going to be a real reflection on the type of relationship and how much they value you and your business going forward. We do know that when the dust settles, processors are going to be very hungry for business, and so this will be a good thing for merchants because if you're looking to make changes or looking to implement some cost reductions, we know that the timing will be very fortuitous for a lot of folks. Okay, so any questions on the good stuff that I mentioned?
No, I think that was pretty good, Thomas. Thank you.
Okay, well, good. So let's talk about the stuff that's not so good. We do know that processors may take this opportunity to actually increase your rates or also hide costs that could appear in your program. So it's going to be more important than ever for merchants or us as auditors to stay vigilant when we're looking at credit card processing statements. We are seeing merchants experience some very steep declines in their processing revenue. So as a result, this can trigger some things that your processor may do. And I want to go over these, and so pay attention to these. First of all, if you see a really steep decrease in processing fees, you might start to see some monthly minimums appear on your credit card processing statements. Those types of monthly minimums are going to be outlined in your agreement, but if you're not doing enough processing volume, your processor has some stipulations in their contract that allow them to charge monthly minimum fees. So be aware of those. Second, again, like I mentioned earlier, processors might use this opportunity to increase their revenue and increase your processing fees because we know that they're experiencing the pinch just like merchants are. Thirdly, we are seeing this, processors may begin to hold funds. So the reason they are holding funds is because they need to be able to cover things like refunds, fees from the previous month, and potential chargebacks that merchants might experience. Our hope is that processors return all these reserves in a timely and honest manner once those fees and chargebacks and refunds have been honored. But do be prepared that your processor may alert you that they are going to start holding funds. So make sure that your business is prepared for that. And we know that there are stipulations in the agreements that allow them to do these kinds of things. So just be aware of that. Another thing is that we are seeing processors shift from a monthly discounting model to a daily discounting model. And so what that means is a lot of merchants are used to paying their fees at the end of the month, or they're used to seeing those credit card processing costs get deducted at the very end of the month. And what we're seeing some processors do is switch from a monthly discounting model to a daily discounting model where they take their fees out of the funds before they deposit them in your bank account. And this can kind of create a nightmare for reconciliations and those kinds of things for a lot of merchants, but just be prepared that we are seeing processors do these kinds of things. Let's see, lastly, merchants also may experience, an increase in or a decrease in funding. So, I'm sorry, an increase in the number of days that you get your funding. So, as a merchant, if you're used to seeing your funds get delivered in 1 to 2 days, there is a possibility that processors may delay the funding of those credit card processing sales. So just be aware of that. If you're used to 1 to 2 day funding, you may start to see 3 to 5 day funding or even further funding delays as well. Okay. Yeah, the next thing that I want to talk about is chargebacks. Processors do charge you for these chargebacks. So if you are seeing your customers increase their chargebacks, if they're disputing charges on their accounts, those kinds of things, just be aware of that this could increase your chargeback costs, and that you may not see the revenue from those sales if there is a dispute on those chargebacks. So just a couple things to mention there about chargebacks. Second to last item here is that if you're looking to either move your business to a new processor or open new accounts, just be aware that some processors are actually being more restrictive on the types of new accounts that they're willing to board. So this means that now may not be the best time to take your business out to bid or to start opening new merchant IDs, because processors are becoming more risk averse and they're not boarding as many customers as they used to before. And then finally, the last thing that I do want to talk about has to do with keeping credit card information safe and secure. And this has to do with PCI or payment card industry compliance. So when you as a merchant start to move towards a more remote model where you've got folks working from home, just be sure that you continue to handle information safely and securely. We are seeing increases in credit card breaches, and cybersecurity experts are also warning of increased cyber attacks and cyber threats. So stay vigilant, make sure that your remote folks are handling information safely and securely, and that they have safe networks as well. So I think that's all I have. Joe, if there's anything that you want to jump in and add as well, I think that's about all that I had. So Bill, I'll toss the time back over to you.
Very good, Thomas. Joe, thank you guys both very much. I think we're just about up on time for that segment. So as our next speaker is going to be Ken Moyer. Kenneth is with a current partner with LJM Group. He's got over 28 years of small parcel industry experience, including 16 of those years in a multidisciplinary role at UPS. He's also assisted Util Auditors to deliver results for clients like Altered State and more. So, Ken, are you there?
I am. Thank you very much.
No problem.
Okay, so some of the things that are changing, especially in the transportation and the small parcel world. So I'm getting calls from, or have been getting calls constantly from customers, everything from $500,000 a year shippers to $200 million a year shippers. And most of their concerns revolve around a few things. Number one is most transportation contracts are what the carriers call self-regulated, meaning the more you ship, the more discount you get, the less you ship, the less discount you get. And that's real problematic in times like this, because not only are companies dealing with slower sales, but as their sales slow, it also increases their cost per shipment. So they're getting hit on two fronts, lower sales and a higher cost to ship those packages. So a lot of them are asking what to do. So that's number one. And then number two, the second category of questions we get quite a bit is what do we need to adjust to the new normal after this? Because there would definitely be quite a few things that are different when all this is over. And we'll talk about that a little bit. So first, let's talk about how UPS and FedEx specifically are responding currently to the crisis, and then we'll talk about what's going on in the future. So the way they're responding currently is, as you might imagine, in general, it's not very good. So number one, both carriers, both UPS and FedEx, have implemented some type of COVID-19 surcharge, meaning they're charging more for shipments. For example, shipments out of China are costing more, and so forth. So there are new fees associated with the virus that did not exist before. And we do not know how long they're going to last. And there is some variance between the two carriers on what those fees are and what they apply to. So that's number one. Number two, with regard to the contract, that self-regulation piece of the contract, neither carrier has announced an official position. However, what we're seeing from UPS, the intelligence we're getting is if you approach UPS and tell them we need help with our contract because of COVID-19, then their standard response is that they will freeze your portfolio tier as of March 7th. And that's really important if you're having declining shipping volumes. That's something I would do like as soon as you hang up. So you have to use the words COVID-19 with your UPS rep, but they will freeze your rolling average so you will not suffer the downturn in your 52-week rolling average based on this. FedEx has not come out with a standard response yet. However, their contracts in general are much less punitive as you ship a little bit less, so the need isn't nearly as great as it is on the UPS side. But if you're a FedEx shipper, I'd reach out to them directly and see how they can help you individually. Moving forward, there's a lot of changes that are taking place. So number one is, as you can imagine, a lot of companies, we've accelerated the curve, I'm guessing 7 to 8 years on e-commerce. So there are customers large shippers that I have that going into this, 7 to 8% of their sales, or 8 to 10% of their sales were online. Right now it's 40%, 50% of their sales are online. Now, of course, when this is over, that number will retreat a bit, but pretty much everyone expects it not to retreat fully. So what's happening is, whereas shippers used to ship the bulk of their shipments to their brick and mortar operation, which meant very few shipments, but very large shipments, heavy weights, large packages, all commercial, now they're shipping, instead of one box, dozens of boxes, and it's going to multiple locations, and they're all residences. So it's putting pressure not only on their contract, because their contract was not designed for that type of shipping volume, right? So it's not a good contract for that type of shipping, number one. And number two, their distribution capabilities and procedures are made to handle a certain number of packages going to commercial addresses, not 4 or 5 times as many going to residential addresses, and it's putting a lot of strain on their operation. So again, when all this is over, that will retreat a little bit, but almost nobody expects it to go back to pre-pandemic levels. So that's going to require changes both in the contract that you have to address your new characteristics, but also in how you process those packages, because you're looking at a very different supply chain than you looked at before that. So if I were to go back and give 3 bits of advice to shippers during this time, it would be, number one, contact your carriers immediately for short-term help with your portfolio tier is the term UPS uses, or earned discount tier is the terms that FedEx uses. I would also assess the changes in your supply chain to see what you think are temporary and what you think are long-term. So e-commerce, how much is that is going to shift back versus not. Another trend we're seeing a lot of folks is alternate sourcing. So companies that used to get everything out of China are now looking for other sources, because that crater in production from China is moving through the supply chain, and now they're finding other sources, and they may not be willing to go back to a China-centric strategy in that. So look at which of those are going to be permanent. And then lastly, once you figure out what truly is going to be permanent, you probably have to make operational and contractual changes to take advantage of that. And we're really seeing a difference out there. We see some folks that are already have their plans in place for when this ends, and they're ahead of the curve, right? They're ready to go, and things are already going to be different. They're ready for the new normal. And then we see other people that haven't begun to react yet. And it's going to change the balance in some industries based on how effectively folks come out of it and how quickly they make those adjustments.
Very good, Ken. Ken, thank you so much. I think you did a great job of covering some important topics there in regards to shipping. We really appreciate you jumping on. Our next topic is going to be waste removal, and my next guest is Marshall Stamen. Marshall is the president and owner of Talismark with close to 40 years of experience in the industry. They are a leader in third-party management of waste removal, and they've assisted Util Auditors with clients like American Air Filters, Enterprise Rent-A-Car, Old Castle Building Products, and more. So, Marshall, are you there?
I am here.
Very good, sir. Welcome to the call. Thanks so much.
Thanks for having me. Okay, so I was asked to spend about 10 minutes talking about waste removal and the changes as a result of COVID. And I have to be honest that over the course of my career, I have saved my clients over tens of millions of dollars on their waste expenses. but I don't think I can talk for 10 minutes on the subject of waste. So my goal is to be brief, be brilliant, and be gone. Okay, so here we go. The waste industry changes due to COVID-19 have included some temporary interruption of non-essential services like recycling, for instance. But for the most part, the industry is continuing to deliver vital waste collection and disposal. Waste haulers are doing their best to manage the safety concerns of their employees, their customers, and the communities. Waste haulers have been inundated with service reduction requests, which they have been honoring within reason. It's not uncommon for them to take 7 to 10 business days to implement those changes based off of their backlog. So here's a key note. It's important that these changes need to be initiated by the customer. Haulers don't proactively review or adjust your service levels. So if you're overserviced, they're very happy to charge you to pick up empty dumpsters. And if you're underserviced, they're just as happy to charge you for overage fees. In addition, the waste vendors are getting stricter on their accounts receivable. They front the money for these services, and they need to crack down. So they are liberally applying late fees. They are shutting off the services for anybody who even has a hint of an overdue invoice. Bad debt has become a real concern for them, and they've got millions upon millions of dollars invested in equipment and manpower, so they have a valid concern. Now more than ever, your waste bill can come back to bite you. Waste and recycling expenses are often at the very bottom of our operating expense list, so now is the opportunity that you shouldn't be ignoring. You should use this time to look inside your waste and recycling dumpsters, make sure you're serviced appropriately, and therefore preserving the money that you would be spending on this. If you wait, there will be no recovering the costs of these unneeded services, no refunds, no credits. Haulers aren't doing anything that hasn't already been in their bag of tricks. You can expect that erroneous fees and tighter enforcement will stay on as part of the new normal. This should be a wake-up call to all of us. To evaluate our businesses and see how nimble and fast-acting we can be to adjust to change. So I wanted to give 4 tactical things to consider when adjusting services. The first and foremost, do simple division. If you're paying $1,000 for waste services and you choose to reduce your services down to 75%, make sure the math works. This is an excellent opportunity for waste companies to improve their profit margins, and just take out your calculator if you need to, but make sure that the ratio stays the same as it was. Okay, the second most important thing, be really careful about signing what they call the paperwork that really is a new contract in disguise. There's no reason to obligate yourself to a new contract term for a simple service change. My third recommendation is when you're adjusting services, try to cut out a day of service or days of service as opposed to adjusting the size of a container. This is going to save you time and money because you're not going to be paying for removal and delivery fees. And once again, always watch out for the junk fees that they put on their invoices. It would not surprise me to start seeing COVID-19 fees on invoices. They charge for everything else. And finally, I would suggest that you anticipate that it's going to take time to ramp back up. Just as like now there's a 7 to 10 day delay in getting your service decreases done, anticipate when you see the business is going to be picking back up, and try to schedule your service increase to be effective then. Because if you wait until the rush, you're going to be trapped in the queue with everyone else. Right now, Talismark is proactively reviewing all of our clients' service levels, taking swift action to adjust. We're ensuring that our clients are only paying for the services that they currently need. And as their outsourced manager, we assume the workload involved with these service changes, freeing them up to concentrate on their businesses. That's what I would recommend, for anybody paying for waste services. Just stay on top of it now. I thank you for your time.
Excellent. Thank you so much, Marshall. Really appreciate it. Some good insight there on waste removal and how to watch your current spend levels and not make sure that you don't get locked into something that you don't intend to. Our next topic is cost segregation, and my next guest is Warren Dazio. Warren is the Executive Vice President of Business Development for CSSI. CSSI essentially originated the engineering-based approach to cost segregation in this industry, so they're by far the foremost authority in the space on the subject, and we're glad to have him. Warren, are you there?
I am here, Bill. Thanks. Can you hear me okay?
Yes, sir.
Great. So the biggest thing, so CSSI has been around almost 20 years. And like many of you guys on the call, we have saved clients lots and lots of money. The difference right now is that instead of just reducing people's income taxes, the CARES Act gives us the ability to be able to give somebody a refund back, a cash refund back. And at a chance right now when everybody's trying to get loans, trying to reduce their expenses, here's a way that you might be able to get cash back as well. So I'll cover 2 or 3 concepts that are covered in the CARES Act and then tell you how you can capture that. So this would apply to anyone that either owns a building or that someone that potentially owns a tenant where you're paying for improvements in a building. Either of these cases would apply, especially if you've recently done improvements on a building. There's a couple of additional things, but the biggest thing the CARES Act did was allow you to do what's called a net operating loss carryback. So what's a net operating loss? I have a year in my business where I had more expense than I had income. That's a loss. So a cost segregation helps create a depreciation loss. So what the CARES Act basically did is if you have a loss and you zero out your 2019 taxes, you have the ability to take that loss and carry it back to 2014. If you paid taxes in 2014, then that would reduce your taxes that you paid and you get a check back today from the IRS. Basically, if you create a loss, you go back to 2014, apply it forward to every year until you use that up and get a refund in the current tax cycle. It doesn't involve amending a return. There's just a simple form called the loss carryback form that you can use to capture that. So that's a great one. And one of the cool things about it is we have done cost segregation for 20 years, but the CARES Act allows us to create that loss to help building owners and tenants out right now. So what is cost segregation? You have a building or you paid for tenant improvements. They go on your depreciation schedule as a straight line item at 39 years or maybe 15 years. And let's say it's a building, you depreciate that $1 million building every year for 39 years. The IRS gives you 1/39 in depreciation expense to offset your income every year. With a cost seg study, you're able to accelerate parts of your property and identify 5, 7, and 15-year assets. That then creates a greater depreciation expense to offset your income. And the end result is normally lower income taxes in the current year. But with the CARES Act, what they allowed you to do is to go back and get a refund back for that. So that's the biggest thing and that they've done. So an action item, if you have paid for a building, if you own a building, or if you've paid for improvements, it's a great time to look at what's called a net operating loss and to see if a cost seg would potentially benefit you. The second thing is they changed a pretty big tax law called the Qualified Improvement Property, and this very much pertains to those people that do leasehold improvements. When the Tax Cuts and Jobs Act came out, they did away with a restaurant improvement, a retail improvement, a leasehold improvement. They wanted to simplify that law, and they called it all Qualified Improvement Property. And they intended you to be able to use what's called bonus depreciation. So if you did any kind of improvement, they wanted you to be able to expense it in the first year with 100% bonus depreciation. Congress wrote the law improperly. With the CARES Act, they have corrected that. So if you did an improvement in the last quarter of 17 and 18 and 19, it typically is an interior improvement, and it can't be a structural item like an elevator, escalator, or the structural parts of the building. You potentially, that whole improvement would qualify for bonus depreciation. You could take it as an expense now. So let's say I'm a restaurant owner. I don't own the building, but I put $300,000 versus $300,000 of improvements in my space. The law defined in the past was you had to depreciate that over 39 years. Now they defined it as a 15-year asset, and you can take it as a depreciation expense now. Again, if you're a restaurant owner, many of you guys have had to lay off your employees, and it's not just restaurant, just using that example. But you can take that loss now, apply it to an earlier year, and get a refund back now. So dentists, auto dealerships, you name it, any kind of commercial property, either if you own the building or you've paid for the improvements, you have the ability to create a loss and go back. And you can do that both with qualified improvement property as well as a loss carryback. And the source to be able to get that is a cost segregation study right now. So that's about it for me. I would kind of an action item, if you were a building owner or you a small business owner that has paid for improvements, contact us through Util Auditors and get in touch. We can create a no-cost pre-analysis for you to see if you can benefit from that. And then with that analysis, we'll get on the horn with you and your tax preparer to see if that's something you can apply in your business. And the good news is that we specialize in all things surrounding the building, very knowledgeable. So we have a lot of CPAs that will contact us and say, can I do this? Can I do that? We will coach your tax preparer through whatever we need to get you the end result. And the end result, hopefully, is cash back in the form of a refund. And how much, if you had $1 million building, we're looking at anywhere from $100,000 to maybe even $200,000 in tax savings per building, per $1 million. So great number. If you're a building owner or you've paid for improvements, let us know, and we would be happy to run a pre-analysis as a starting point for you. Thank you, Bill. That's all I have for now.
Absolutely. I really appreciate it, Warren. Thank you so much for jumping on. I looked at our final topic is telecommunications, and our next guest is Charles DiPietro. Charles, are you on the call?
Yes, Bill. Yes, I'm here. Thank you. Thank you all for coming and listening. My name is Charles DiPietro. I say that for my mother, but anybody who knows me calls me Chuck. I've found the other presenters' information very helpful. I hope you have too. With regard to telecom, well, there is no one-size-fits-all answer to this question. How does the pandemic affect telecom? The answer varies by company and carrier and service and industry. And the short answer is that the pandemic has certainly heightened the awareness and the importance, or perhaps lack thereof, of an effective disaster recovery and business continuity plan. Disaster recovery and business continuity planning is like an insurance policy that you get. It can be as expensive as your pockets are deep, and it's often the sticking point between IT and finance. IT, of course, wants to build their network bulletproof, and finance wants to be sure that their dollars are being spent wisely. But disaster is not just hurricane or flood, although they are very real. The most common concerns reported by a national survey of C-level IT professionals report that 65% of them believe that power failure is their biggest disaster point. So they go and they install battery backups and generators, and they feel like they may have minimized that exposure. 65% cite network outages, so they provision alternate call routing plans and multiple data connections over different mediums such as fiber, cable, and wireless to help spread that risk in the event that one of those mediums should fail. And 55% surveyed claim that hardware failure is their biggest pain point. So they stock their closets with spare parts, crash kits, switches, routers, and maybe even servers in the event that they should experience an equipment failure. But what it's done, the word disaster has lulled some companies into a false sense of security. Among the host of elements in the disaster periodic table, disgruntled employees and revenge is up there. Vandalism, hacking, and cybersecurity, certainly. Water damage from space above. Nothing had anything to do with you or anybody else in the neighborhood. Terrorist attacks and building collapses like 9/11, or supply chain disruption. What if your vendor has the disaster and can't fulfill their supply to you? And of course, we're talking right now about pandemic, which has caused a lot of our companies to rely on an absentee workforce. The term disaster recovery and business continuity are often interchangeably, but there's two different components that work together as part of an organization's recovery plan. Disaster recovery is primarily concerned with the systems and infrastructure, and by definition, limited in scope, with the ultimate goal of complete recovery within a defined period of time. Whereas business continuity is an attempt to blend the IT emphasis of disaster recovery efforts into a larger scope determination of which business units and functions must be prevented from interruption, or if interrupted, the priority to which they are restored. And some of those key components include emergency response procedures, of course, damage assessment and insurance claim processing, a plan to handle phone calls, websites, emails, executive communication plan, a communication plan for clients and vendors, an employee communication plan, banking and payroll plan to keep your business going. The other one that somebody doesn't know, people think about or rarely do, is a public relations plan. If somebody buys a bottle of Tylenol and figures out it's cyanide down the road, there's going to be some explaining to do from that drug manufacturer. So the long and short of it is that you can have a recovery plan without business continuity, but you can't have a business continuity plan without some degree of disaster recovery. So from a customer's perspective, how does our voice and data carriers provide flexibility, and our vendors, how do they provide flexibility? Well, there's two kinds of customers, and they're provided in two different ways. Customers who rely on customer premise equipment have a unique set of challenges because all of their systems are in-house and primarily count on people sitting at their desk to access those systems. There are other methods of technology like hosted and cloud-based systems that provide a greater degree of flexibility and redundancy. For example, a voice over IP telephone user can unplug their phone from their office and plug it in any internet connection around the world and function as if they were sitting at their desk. And with some degree of unified communications, they can pass calls from their phones to their cell phones, from their cell phones to their voicemail to their texts, emails, email to text, whichever way they think about it. So in the future of your carrier relationships depend on the services and the companies that provide those services and how they can react in times for need of change. Right now, carriers are experiencing a lot of cancellation orders because companies aren't prepared to have the services that they've ordered delivered. They can't get to their buildings. They don't know how long this is going to last, so they're prolonging the delivery times. And the new orders are experiencing prolonged delivery times from up to 3 to 4 times their normal intervals because right now, efforts are being focused on service-related issues, and when all this clears, there may be a longer prolonged interval than that. The bad news is that the payments to the carriers are still due. Suspensions and disconnects due to non-payment, they vary by the carrier, the amount owed, but most important is probably your payment history. Competitive local companies that provide service still are accountable to their underlying carriers to pay their phone bill. So the smart thing to do is to talk with your carrier and find out what flexibility they may be able to offer, because no one's going to get carrier services for free forever. So the action items here is to talk to your carriers and vendors about an option in developing a short and long-term strategic plan that fits your company's IT objectives. That can include a technology refresh or a change in technology. And you would do that by conducting a feasibility study that would minimize the impact of all possible future disasters. But to do that, it's probably a good idea to conduct an audit of your IT expense, the inventory, and your disaster preparedness so you can make informed decisions about the first two items I mentioned. An audit is a good way to find the fat in an IT budget that will help offset or pay for technology refreshes or changes in technology without going to finance and asking for more money that might not be in the budget. So I want to thank you all for listening. If you have any questions, please contact Util Auditors and we'll set up a time to get into this a little bit more in detail. I wish you all the best out there. Stay well, stay healthy, and thank you for listening.
Very good, Charles. Thank you so much. I did receive one question. Ken, are you still on the call? I received a question in regards to shipping. Maybe we can cover that.
Yes, sir.
On shipping, I had a question of how do you find information about delays, etc., of foreign shipments getting through U.S. ports?
Well, most of the time those are on, I would check your carrier's website. So again, my specialty is a small parcel. UPS and FedEx both have a news section where they update those types of things. If you're using a consolidator or a heavy freight shipper, usually they have something on their websites as well. Also, if you're looking at more of our customs, then you've got the Department of Commerce also has a website that will give you general guidance. You're not going to be able to look up a specific shipment, but it'll tell you, hey, these countries are experiencing delays. But typically the best source of that information is the carrier that currently has your goods.
Excellent. Thank you so much. I just wanted to say in conclusion, thank you all very much for joining and taking the time with us this afternoon. Obviously, it's my hope to have conveyed some valuable insight and information, and I'm sure there's going to be additional questions that are unanswered and that might require a deeper dive to understand if they're case specific. Feel free to contact us at Util Auditors, and we'll be sure to get the most appropriate resource to get the best answer for you. Until then, obviously, we look forward to a better economy in the second half of 2020 and beyond, and we're here to help businesses make the most of these unprecedented circumstances in the meantime. Thank you, guys. Thank all of you panelists very much for joining the call. I really appreciate it.